going to get started on our first Actuaries Institute virtual webinar. I might start by just asking everyone who's not speaking on my panel to put themselves on mute, just to make sure that we have the best sound we can. So welcome everyone to our first Actuaries Institute virtual webinar. First of all, I'd like to acknowledge the traditional owners of all the lands across Australia and New Zealand on which we're gathered, and pay my respects to their elders past, present and emerging. In particular, I acknowledge the Camaragal people of the Eora Nation on whose traditional lands I am speaking from. So today's a webinar to give you an update on COVID-19, the situation, and what our working group is doing to support the profession and the wider community in response. So today, on April the 16th, there have been over 125,000 deaths around the world from COVID-19. There have been nearly 2 million recorded positive tests for SARS-CoV-2, that's the virus that causes COVID-19. And in Australia, to April 16th, there have been nearly 6,500 positive tests and 63 deaths. And in New Zealand, there have been 9 deaths so far, with around 1,300 confirmed and probable cases. The ASX 200 index in Australia dropped by 30% from 31 December to late March, and now it's only around 20% off that 31 December peak. And the 10-year government bond yield has been under 1% since late January, reaching a low of 0.68%. So there's a lot of things going on that affect all of our profession and in many different ways. So with that context, I'm now going to share my screen, so bear with me, this will take me a moment, to just give you a sense of the agenda. Apologies, I'm just trying to work out how I get to the next slide here. So the agenda for today, sorry, I just wanted to check, can people see the screen?
Yes.
Great. So the agenda for today is an overview of what the working group is doing, and then we're having specific comments on various practice areas. First of all, general insurance from Winley Toe. Next, life insurance from Daniel Longden. Superannuation from Jeff Humphreys. Health from Andrew Matthews and Ignatius Lee. Stress, scenario and stress testing from Paul Nuttall. And then we'll be doing Q&A. So first of all, the Q&A we'll be doing was on practice areas, on the specific presentations that we've seen. And then we'll be doing a general comment, if we get time, to talk about what the working group should be doing and what it is currently doing. So before I get started, there's just a couple of rules of engagement I wanted to talk through. All participants of this webinar, except presenters, are automatically on mute. So during presentations, please use the Q&A commentary to raise questions or comment. Everyone can see those Q&As if you send them to everyone, so it can be used as a bit of a discussion forum. And then if you send all questions or comments to all questions, and then we'll try and answer the questions at the end of the presentations. I expect all of you are familiar with Zoom by now, but we'll do what we can. So we have over 400 participants. In fact, I think the last I saw was over 600. So we may not be able to answer all the questions if we get a lot of them, but we'll do as many as we can. And then we'll take all the questions away to the working group and to the relevant practice committees to follow them up. We're also expecting that practice committees will be having insight sessions in the coming weeks on more specific questions for their areas. So the working group. First of all, we needed to think about what our challenge was. What should we be doing? Why would we have a working group? We're responding on behalf of the actuarial profession to this situation. So first of all, we looked at what our skill set is. We wanted to make sure that what we were doing was something that was where we have a unique advantage and we can actually add value to this crisis. So we thought about our skill set, which is a professional and independent outlook, skill in scenario testing and modelling out to the future, a crossover between statistical and financial insights, skills in long-term projection and modelling, and explaining risk and uncertainty to boards and senior management. So those are the areas that we think that we specifically uniquely add value to. We wanted to make sure that we were doing things that were worthwhile for the profession. And then the second thing we looked at is what actions should we be taking? What should we be doing? So the first thing was to helping our profession and broader society understand what's happening in terms of statistics, data, and alerts to appropriate research. I'll talk a little bit more about this in a second, but what we're doing in the resource centre is trying to fulfil that criteria. Secondly, we're looking at supporting actuaries to fulfil their professional roles during this crisis. So that's a really important thing. Many of our actuaries are supporting companies that have varying degrees of stress, and they need to help those companies to work out what the impacts of COVID-19 are, both on the asset side, the liability side, and the operational sides. So what we're doing is looking at dialogue papers for individual practice areas, providing guidance to companies on scenario and stress testing, writing checklists for FCRs, ICAPs, what should you do about your accounts, what should you be doing about your assumptions and APRA returns, and trying to provide monitoring of regulatory responses. So things like making sure that we're keeping an eye on what APRA is asking us to do, for example. Then we looked at more of a wider perspective. We're also trying to make sure that we're helping the wider community and wider thinking. So we're in regular dialogue with the Australian Government Actuary via the New Zealand part of the working group. We're also in regular dialogue with the Reserve Bank of New Zealand to try and make sure that if there is something that we as a profession can do to assist with understanding the impacts of any aspect of this crisis, we're there to help. And finally, we're liaising with international actuarial bodies just to make sure that we don't reinvent the wheel. So I put up on this slide the working group membership. So I'm the convener, and you can see from the various membership of the peak working group that we've split it up into the various areas where we think we need to look at and add value. So Andrew Matthews for health, Daniel Longden for life insurance, Douglas Isles for investment and policy, Estelle Pearson for general insurance, Ian Lachlan boards and APRA, Julia Lessing government and social security, Michael Rice for retirement incomes, Paul Nuttall stress and scenario testing, Peter Yates for risk management, and Oliver Wood as the secretary. We've also have Fred Rowley and Shami Shearer looking at international liaison widely for Fred and Shami for New Zealand in particular, supported by the Institute professionals to make sure that we're doing the right thing in terms of how we can feed things into the membership. And I wanted to particularly thank all of the members who have volunteered to help with this work. We've had more than 80 people volunteer to assist. Many of you have already assisted either directly or indirectly by supporting people putting together both this presentation and various other parts of how we're supporting actuaries advising their companies. So thank you very much. It's a tribute to the actuarial profession that we have so many people really keen to assist and make sure that we do the best we can during this crisis. So there is already a pandemic resource centre up on the Actuaries Institute website. We're going to look at how to make it easier to find and easier to use. Right now what we have on there is blog posts, professional practice assistance, links to data resources both here and overseas, and updates from government and regulatory bodies. We are going to put together a discussion forum for members only to enable members to share information where they're comfortable sharing it with each other, which is not necessarily with the wider community. So for example, helping people to think through what assumptions might be in different practice areas, how to deal with accounts both now and through the coming months. For example, the Life Insurance Actuaries are very keen to do some work on case fatality rates, sharing information across the world. So this is really to fulfill our two main areas, supporting our membership as professionals and adding our skill set to the wider community conversation. We're particularly at the moment focusing on supporting actuaries writing FCRs and reviewing RCAPs and scenario and stress testing. This won't be formal guidance, but what it will be is information to help actuaries to make sure that they've considered everything they need to. So the first high-level note on scenario and stress testing will be coming out this week, and Paul will talk a little bit more about that. So that's a very high-level view of what we're doing as an overall working group. And what we thought we could most usefully do with this very first webinar was talk from each of the major practice areas about what we're doing in those areas. I'm sure that we'll have more in the coming weeks and months, but right now the purpose of this is a very high-level view of how can we help the profession and what are the big issues that we're facing in our different professional areas right now. So with that, I'm going to stop talking about the overall working group and I'm going to hand over to Winlee To. Winlee is the chair of the General Insurance Practice Committee, and she's also a principal at Taylor Fry. So I think I've stopped sharing my screen, Winlee.
All right, okay. Okay, good morning, everyone. Can you hear me, Jennifer? Right. Thank you, Jennifer. Looks like General Insurance drew the short straw to go first. As Jennifer said, I'm Winlee, the new convener of GIPC. I've been in this role for just over 2 weeks now, which is excellent timing, I think, to take it on. Jennifer has asked me to talk briefly about the challenges of COVID for the GI industry in a broad sense, and what the GIPC is doing to help members navigate through some of the professional issues. So first, COVID impacts on the general insurance industry. Whilst there's obvious strains across the industry arising from a slowdown in the economy, what sort of my preparation and thinking dealing with the COVID issues for today's session and with clients over the past week has brought home to bear is that the GI industry is very vast and very varied. And what we're seeing and assessing is that the impact will be very different depending on the class of business. So I'll talk through, well, let me look at some of the classes that are most heavily impacted first. Travel insurance, which is the most obvious. They're grappling with cancellation claims, premium refunds, and basically inundation on their call centers and their claims staff, and the prospect of $0 in revenue for some indeterminate period. So who knows whether it'll be 6, 9, 12 months. Will it ever recover? How deep cuts can they make in order to be able to stay solvent and be able to ramp up again when things get better? So that's some of the issues with travel insurance. Then there are also those classes that are most impacted by the economic issues. So the obvious would be trade credit, surety, and guarantees. So we're looking at something like 3 to 4 times the default rates for those classes if the GFC experiences anything to go by as a guide, and the IMF is predicting worse. So who knows where that will end. Lenders mortgage insurance, they'll feel the effects of higher unemployment and a forecast drop in house prices, which might impact claims frequency and claim sizes. Professional indemnity and directors and officers. This is where insolvencies may lead to claims against certain professions and more class actions. I think this could take some time to play out, so the ultimate impacts are very uncertain at this time, but we know it will be a negative impact. Moving on to builder's warranty, undoubtedly there will be more builder insolvencies, and leading to more non-completion and defect claims. So these are the ones we think most impacted by the economic strain. So moving on to longer tail classes like workers' comp and CTP, there will be a decrease in the return to work opportunities that may lead to extended periods of claim, with potentially escalating mental health issues, a problem that will emerge. In terms of the COVID actually making people sick and being off work, obviously some professions are more at risk of this. So I'm thinking here of health workers and perhaps some of the retail staff who have closer contact with customers. So is there any good or even moderately neutral news is what I was thinking in all this doom and gloom for the GI profession? So maybe is my answer. It's been widely commented that some classes such as motor or contents could be seen as beneficiaries, since our cars are all locked up in our garages, so there are fewer collisions. We're all locked up at home, talking from our home offices and so on. So there should be fewer burglaries unless we're particularly, insensitive to people climbing through the window as we're at home. But even that view, I think, is nuanced. In the medium term, I think there's a potential for supply and demand pressure to push up repair costs for cars, as well as possibly on imported building materials from China and elsewhere. So already, if you actually read the news in the US, there's already several large auto insurers that have already been providing premium rebates to their customers. So the question I have is this going to be an issue for Australian insurers. Will we become under pressure to be providing premium rebates, at least in the short term? So that's makes the good news and lower claims less of a good news. Let's move on to commercial property. Even there, we have a potential increase in arson because of straitened economic conditions. So that's, again, if you take the experience from the GFC, that's what occurred. So look, so there are a number of other classes: liability, marine, business interruption, etc. But the point I'm making is that general insurance is wide and varied. The impacts are different and nuanced, and there are a lot of issues to think about that are different and specialist to each class. So for actuaries, I'm not going to go into those other classes because I'm under strict instructions to keep this to 8 minutes. So for actuaries, we've been more involved in some things more than ever before. So for myself, I've been reading some policy documents and reinsurance documents a lot more carefully than I ever have done before, really to determine which sets of claims are excluded or not. And believe me, these documents are not straightforward. I think we won't put it to actuaries. We'll put these to the lawyers to make them a little bit clearer in the future. But irrespective of what the documents have said in the past, I've noticed that some of our clients have decided the right thing to do is to offer ex gratia payments where these are sustainable for the insurer. So particularly for the customers that they see as most vulnerable. So I think this is a good segue for me to talk about the vulnerable customer. So with all our complete obsession with COVID and our lives totally consumed by it, what will be the impact or otherwise of the new consumer legislation in this climate? Hey, do you all remember the Hayne Royal Commission? It wasn't that long ago, but nobody's talking about it now. Design and distribution obligations, unfair contract terms, protection of vulnerable customers, etc. These are all still coming, and we still have to grapple with these and still help our clients through them, COVID or not. And I imagine that the vulnerable customer and the number of vulnerable customers will increase, and will have greater financial vulnerability as well. So I think the issues are exacerbated, and we've got lesser time to deal with it. So that's all I wanted to say about general insurance as a whole. I hope I've given you a flavor of the issues that we're grappling with. The second part of my session, which will be very brief, just a minute, is what is the GIPC doing to support members through some of the professional challenges arising from COVID. Yesterday, we held an AA forum, appointed actuaries, that is, not Alcoholics Anonymous, for those that stuck inside. We noticed that 69 attendees, we had 69 appointed actuaries, which was fantastic. And the technology held up. I was very pleased about that. To discuss issues for consideration in the AVRs, so Actuarial Valuation Reports, and the FCRs. Recognizing, so sort of some early thoughts about it. And we had a very robust and interesting discussion. And we recognized that obviously it's early days and the situation is still evolving. The feedback from that session gave us what the feedback from members gave us from that session is that they would like us to host and share more information on professional issues. So AVRs and FCRs were a good start. And we'll move on to ICAPs. There's some volunteers to look at risk margins, which will obviously change in this period. And we'll also try to get together some specialist groups. As I've said, you know, workers' comp and trade credit and so on is very different for a deep dive into the particular classes. We will also try to act as a liaison with APRA on GI specific issues and as a conduit for escalating claims for individual practitioners. So there's a lot to do, no time to waste. And if I might just allow myself 10 seconds to say, we've already had a lot of volunteers, but those who want to volunteer specifically to look at general insurance issues, please let the GIPC know. So thank you. I think that's enough for me.
Thank you, Winley. That was great, and I think you perfectly met your time. So thank you for that. And I would encourage people. We've had a couple of questions come through already on the Q&A. We are going to try and take the questions after all the presenters because I think that's going to make it mechanically more easy. But if you have a question for any of our presenters as we go, just type it in, and we'll manage that as we get to the question time. So our next speaker is Daniel Longden. Daniel's the key life insurance representative on the COVID-19 working group and is a partner at KPMG. So I'll hand over to Daniel, who has a presentation.
Thanks, Jennifer. Let me just share my screen. Is that there? Everyone can see and hear me? Yeah. Thanks. So thank you. First, I want to thank everyone who's volunteered for the life insurance stream of this working group. We've got a group of over 20 people representing most of the insurers in the industry. So we've got a very good mix to bring the expertise to dealing with the topic of COVID-19 for life insurers. In terms of looking at what we're covering in that group and where we see the issues, we can break that down into the obvious first one being just the direct impacts of COVID-19. So there's already been a lot of work looking at the various statistics from both Australia and around the world on infection rates, severity of infection, and ultimately implications for mortality and morbidity. So you've seen through the Institute blog that there's through Alex Stitt and Michael Dermody and other people tracking a lot of that information and looking at how it might translate to the Australian context. We are seeing lower mortality rates in Australia. Some hypotheses around what that may be in terms of infection rates and level of testing across different countries, and also comorbidities. So is there an impact if you look at some of the countries with higher mortality rates? They are in their winter, so potential comorbidities for flu and pneumonia have been raised as potential issues. What our working group won't be doing is putting a basis and coming up with a single consistent view. The intention behind all of these is to look at what information is out there and point actuaries working in this area and to the relevant sources, and try and get consistency in debate and considerations as people are looking to set their assumptions for their own companies. When we look at morbidity, again, direct impacts, probably relatively light at the moment. So we'd be expecting some short-term IP claims for people actually off work because of the virus, so directly impacted through infection, and also some trauma contracts in the life insurance space have ICU benefits, so payments if you're in ICU for a specified number of days. So some direct impacts for claims directly related to COVID-19. There's a whole range of information, and probably we see our role as trying to distill that information and make some sense of it and translate it to the Australian context. What's probably more interesting and potentially more significant from a life insurance perspective is the indirect impacts of this. So really flowing from the measures taken by the government and the states to address the spread of COVID-19 and essentially shut down the economy. So if we break that down into individual implications, then we're obviously looking at the direct economic impacts. So what's this doing to people's insurance balance sheets, asset values, investment return assumptions, credit spreads? What are our views around GDP impacts, both in the immediate term and the length of time for recovery, impacts on inflation and unemployment rates? All of these items feed into valuations, both on the asset and liability side for life insurers. It may be directly in the case of investment products, where guarantees are starting to bite from an investment product perspective, management of participating books and looking at any changes to investment strategy or bonus strategies around those. So we've got that direct impact. But then the more important element for a lot of life insurers is what are the flow-on impacts of these for claims costs? And the most obvious correlation is unemployment rates and morbidity claims, so both TPD and income protection. Now, we've seen previously from recessions and through the GFC that we have some correlations between morbidity rates, both IP incidence, termination, and TPD rates, with economic conditions. There is some limited data on that, and some studies that have looked into those correlations. But we're dealing with a whole new scenario here. We haven't seen this scenario before in terms of the abruptness of the decline in economic activity and the uncertainty around the recovery levels. On the positive side, unlike prior studies and prior recessions where we've looked at this sort of data, we have got a lot more aggressive activity by the governments to step in and cushion the blow. So there's a lot of there's a lot of data out there, and a lot of reports, studies, forecasts around what the economic outcome of this may be. But tying that to our insurance claims experience is going to be a very tricky exercise, and may take a significant amount of time to work through. And we have very limited data to understand what's going on. And I'll come back to the data issue in a second. And obviously the main area we're talking about here is the impact on mental health claims. So we've got a lot of stress and mental health conditions in Australia already. What have we got as lead indicators to see how the lockdowns, how unemployment rates are going to impact that, and what that may flow to in terms of assumptions and what we expect to see coming through in claims. In the immediate term, increased IP incidents, potential impacts on reduced terminations on your existing IP claims and those new claims, and new TPD claims coming through. And it'll be over a period of time where we see that experience emerge. And what we really need to think about is what lead indicators we can pull together for the industry to look at that. If we quickly move on to other types of assumptions, then obviously persistency is a key one. Persistency, lapse rates have probably dropped off in the immediate term as people hold on to their insurance covers. But what will be the longer term impacts there? With a number of factors coming into play. Obviously affordability due to the economic downturn and unemployment rates. What individual companies do and what we do as an industry for hardship provisions in terms of waiving premiums, premium holidays, giving cover holidays on cover, and then the flow on impacts to selective lapses. So what will we see in terms of experience on the remaining policies if we see as this progresses significant amounts of lapses for healthy lives? So a whole range of impacts there which may have conflicting or correlated impacts on both our lapse experience and our resulting claims experience. We've already seen some movement across the industry on underwriting and approach to underwriting, but this will play out further as we go through this, moving to look at, well, what are companies doing in terms of individual underwriting approach? What are we looking at in group schemes? So how do we rate this risk? And is any risk mitigants put in place? Or are we looking at, ultimately the solution is, writing out experience and potential repricing? So there's impacts both on the underwriting approach, new business volumes, and the sorts of products and maybe features that companies are willing to have in market at this particular point in time, both in the retail segment and the group segment. And there's a number of considerations to play through there. In terms of new business volumes and lapse rates volumes, then a flow on impact of that is looking at unit cost impacts. So what does this mean for both acquisition and maintenance unit costs? And it's a flow on impacts both from a best estimate reserving perspective and ultimately a capital perspective for insurers to think through. So overall, a huge range of impacts that could come through from the indirect consequences of COVID-19 rather than the direct consequences. And probably this is the area where it's going to be a lot harder for us to predict. And what we're looking to do as a group is think about how do these correlate together? What sort of ranges we maybe see? What evidence have we got from previous experience that we can draw on and modify based on the individual circumstances this time around? And what guidance can we give to practitioners to help? Then quickly, well, what will we do with this information? Then obviously, as I hinted at there, we're not going to be setting assumptions and giving guidance on, these are the rates for mortality, morbidity that you should be using. But we certainly want to provide, guidance notes or information notes and checklists around what should you be considering in looking at assumptions, both from a best estimate perspective and from a risk margin perspective when you're looking at your capital position. So the flow on from what you take into your best estimate assumptions, what comes through in your regulatory capital, and what you may do from a target surplus perspective, all has interactions here, and you've got different degrees of flexibility in terms of where you may allow for the full benefit, for the full impact of the COVID-19 pandemic. Obviously, that flows straight through to ICAP, where actuaries will be heavily involved, and reviewing ICAP frameworks Is existing monitoring appropriate? Are you looking at the right metrics in terms of the immediate impacts and those emerging impacts? What trigger points have you got? Are they still appropriate? Should they be varied? Should they be relaxed? Should new trigger points be brought in for management actions? And what management actions are available? And the obvious one that most insurers have is repricing. What are the strategies around repricing? To what degree can we expect to reprice as an industry at the moment, given the community outcomes of putting premium rates up at this particular point in time, and expectations of both the government and regulators? And we've seen that play out in health insurance already. And scenario testing, so looking at the scenarios that you're using, it's still appropriate. Should we be looking at additional scenarios? How do those scenarios play out when potentially your best estimate assumptions now include a scenario which includes maybe is it a 1 in 100 event that you've already got built into best estimate? So in terms of looking at a 1 in 200 shock, or a 1 in 40 chance of meeting your regulatory capital requirements, does that mean that you should be looking at scenarios differently and allowing for different interactions in those calculations? For FCRs, then some people are in the unfortunate position of a 31 March year end. So our main recommendation from a practice group would don't have a 31 March year ends, but unfortunately it's a bit late for us to put that advice out. And there are a number of companies obviously coming up to 30 June year ends. So what should be considered from an FCR perspective and a evaluation report perspective around these issues? Data, I just probably turning back to that. Usually when we're pricing, we're in the luxurious position of having industry experience investigations that are probably half a decade out of date. Here, as I've mentioned already, we have a lot of things which are completely new, completely unknown. So I think there is a question, which I'll probably throw to the Q&A, is what should we be collecting at an industry level at the moment for data to help the industry, again, pick up on those lead indicators of what's happening here and what may develop particularly from mortality and morbidity experience on those income protection portfolios, which could be hit quite hard. A range of other guidance and information checklists we'll put together around other considerations, which flows back into both ICAP, FCRs and valuations. Operational risk, what's changed with people working from home remotely out of the office? How is infrastructure and technology holding up? There's been issues with outsourcing, particularly where that's offshore, and offshore facilities have closed down. And capacity planning, and particular consideration there is if we get a lot of new claims coming through, how do our claims teams cope with that? And does that actually change the way we manage claims in the short term? I'll stop there and hand over to the next practice area. Thank you very much.
Thanks very much, Daniel. I was just waiting for the screen sharing. So our next practice area is superannuation. I'm going to introduce Jeff Humphreys, who's representing the Superannuation Practice Committee on the working group, and he's a principal at CHR Consulting. So I'll hand over to you, Jeff.
Thank you, Jennifer. Just set up my... Hopefully that's working. Okay, in superannuation, we've looked at 3 streams: defined benefits, insured benefits, and other areas that affect superannuation funds. Jennifer's been through the sorts of outputs we'll be producing in terms of checklists, considerations, information notes. We do look to people to make their contributions and put through queries or add any issues that they think of or would like people to be looking at for the profession as a whole. So first one, defined benefit funds. Clearly there are funding issues with a drop in the returns to very negative returns. Actuaries have been here before, and this is not a particular concern in terms of experience for defined benefit actuaries. The early release of benefits may be a bigger issue because we haven't been there before, and the funds will have to decide whether they're willing to do that on the defined benefit side or not, and what the impacts might be on the fund. Change in employment status. Some changes aren't coped with specifically under deeds. People being stood down, salaries being reduced, hours being reduced, and how do you treat the JobKeeper payments. And this is all in relation to things like an impact on accruals, salary for super, member and employer contribution rates and amounts. So at the end of this presentation, I've put together the considerations checklist for defined benefit as a bit of a working document put together by Matthew Burgess and Louise Campbell, and very, very useful already for actuaries working in this area, that checklist. On the insured benefits side, we've got a partnership really going between trustees and insurers to provide these benefits, and it only works in that circumstance. Trustees recognise that their experience and their price are heavily linked, but they also have an obligation to act in their members' best interests. So some of the issues that are going to arise on the insured benefits side for the super funds are what's going to happen with cover, particularly in relation to salary dependent cover, which of course is most income protection, but it can also be the formula for death cover or CPD cover. How are we going to treat job seeker, hours dependent cover? What's going to happen there? We have the impact of early release, which may trigger a lot of cancellation of cover, and the interaction with the PYS and PMIF legislation and workers' comp. One of the key things that the trustees will be looking for is communication to members before claims time on the treatment of these unusual circumstances. How are we going to treat members, for example, who are paying a full premium, but for some reason their sum insured has reduced because of their circumstance, and they continue to pay that full premium. So there'll be a lot of focus on value for money, I think, in these scenarios. Claims experience, Daniel's been through a lot of that. There's a lot of crossover there. Of course, the insured benefits we're talking about here are the working population who tend to be healthier and fit into certain age groups. So they're a subset of the Australian population, a subset of the total insured population. Probably not a direct death cost for the industry. Will be a disability cost, and we're thinking mental health. There'll be direct and indirect impacts. There'll be pluses and minuses. Trustees will be looking at these and working with their insurers. Some of the indirect costs, in fact, most of the costs are indirect. We think there could be increases in other causes of claims because of the reduction in people seeking medical advice or accessing medical treatment, and at claims time being able to access the necessary medical treatment. And there may also be an impact if insurers don't staff up for the tsunami of claims that may be coming through, particularly in relation to mental health. There could be some downs as well, things pushing claims costs down. I mean, one thing that I think is very important is comorbidity. In a lot of cases, we're bringing forward claims that the industry would already be paying in the next couple of years. And to this extent, we need to allow for that and not overprice. There's a comorbidity is a key indicator of mortality, and so we see stats. 88.5% in New York, 98% in Italy are people with a comorbidity. Claims management will be a very important area. Particularly how we treat grey claims that may not normally be assessed as payable. And we've mentioned caseloads. Pressure on premiums. Trustees wouldn't be expecting the repeat of 2014-15 where pricing went through the roof and there was a loss of a partnership approach to these benefits. And we note there's now a 1% rule that is in place that limits trustees' abilities to increase premiums in any event. And we'd already started an information note on the interpretation of that rule, and of course that has more importance now. We're also looking at mitigation and levers. What things can we do to ensure the members, I guess, are still getting a valuable product out of our industry. Data is very important. Is it being recorded? How's it being recorded? Is it being consistently recorded? Will we be able to actually work out COVID claims for disability in the future? There was a claim that would not otherwise have occurred. Are databases ready? Are they being updated? These are the important issues that trustees would be looking at from their insurers, because they rely on the insurers for their data on the claim side. Now, on other issues, super funds, of course, face a number of issues like all financial institutions out of this. There are investment issues, liquidity, unit pricing, and equity between cohorts, illiquid asset valuation, sustainability of the fund. And we have a practice guideline on 49905, which is a financial condition report for super funds, which is not a legislated report. And it may be of use to actuaries, advising funds on their sustainability. And of course, there's a fee sustainability problem because most administration fees and investment management fees are asset-based, and the asset base has fallen. On the administration side, ability to process benefits through liquidity or staffing issues, and we have the perennial problem of confidence in super, negative returns, call for super guarantee suspension, and the lack of super contributions coming through. And the last question, fund mergers up or down. That some of them been put on hold, some of them might go ahead faster. Thank you, Jennifer.
Thanks very much for that, Jeff. While I'm waiting for the screen to switch, I'll just remind everyone about the Q&A. We are getting questions through, but do keep them coming. We'll try and answer all of the ones that we can. And I noticed that at least one of our presenters has already answered, so we can have a live chat as well as the Q&A. So our next speakers are from Health. Andrew Matthews, who's a principal at Finity Consulting, and Ignatius Lee, partner at Deloitte Consulting. Andrew's the representative on the COVID-19 working group, and Ignatius is in the Health Practice Committee, and they're going to talk through the health issues. Over to you.
Hello, I'm Andrew Matthews, a principal with Finity Consulting and an associate professor at Monash Business School. Today I'm joined by Ignatius Lee with Deloitte and chair of our Health Practice Committee here at the Actuarial Institute. A word about our format. We're going to take you through an appreciation of issues for health actuaries, and in the next 10 minutes we'll cover a review of what's happened so far, and then Ignatius is going to cover what's coming up for the Health Practice Committee. First of all, a review. What's happened for us as health actuaries so far? I think it's summed up in the first sentence. We face the twin systemic issues of a pandemic and severe economic disruption. So I'll cover each of those. The pandemic, well, I suppose you could say experts warned us that a global pandemic was if, not when. Still, this one caught us unaware in speed and breadth, starting around December 2019, which doesn't feel that long away, and yet lots has happened. There's been over 2 million confirmed cases of COVID-19 and more than 120,000 deaths. There is no immunity, and the virus appears highly contagious. A vaccine is seen as the ultimate solution, but I'm told that it would be a Guinness Book World Record if it was in place inside 18 months. The initial response in Australia has been focused on lockdown. The intention is to break the chain of transmission, and the words you've all heard numerous times, flatten the curve. It's really about buying time and not overwhelming our health systems. It's not a long-term solution, and the next phase is likely to be based on learning from those countries ahead of us and include widespread testing. So what have health actuaries seen so far? We've seen a premium freeze for health insurance. A premium increase was meant to come in on 1 April this year. It didn't. more government intervention in health. We saw a ban on elective surgery in private hospitals and enhanced coordination of public and private systems. We've seen media recently about potential super profits in health and a debate about deferred elective surgery. I know my colleague Winley talked about what's the silver lining. Well, you know, it's hard to talk about a silver lining amongst the misery that many people are facing. But if we were going to pick a silver lining, it would be there is faster reform happening in the health industry than has ever been seen right around the world, which creates enormous opportunity for coalitions. And an example of that would be telemedicine. The spending around the globe and in Australia on increased connectivity between patients and virtual health providers is quite amazing. That takes me to severe economic disruption. We've got around 50% of the world in some form of shutdown or lockdown. So unemployment is up, hardship is up, growth is down. In Australia, this comes right after our bushfire crisis, and the response so far has been a huge economic stimulus, but health insurers are facing increased cancellations, increased demands for premium holidays, and pressure to cut premiums. So that sort of sets the scene. Ignatius, I might turn to you. What's coming up for the Health Practice Committee amidst all this uncertainty?
Yeah, thanks, Andrew. Good morning, everyone. So HPC's agenda is really about supporting actuaries during this unprecedented period. And our context is really driven by both the health and economic impacts that Andrew just outlined. Government is in a really unenviable, tough position of trying to strike a balance between adverse health outcomes and adverse economic outcomes. And the two are not mutually exclusive. So how they strike that balance really affects the course of infection. And the success that we achieve at flattening the curve in turn impacts on the availability and utilization of private hospitals. And so very much from a health insurance perspective, it impacts on the level and volume of health insurance claims. Now, physical distancing measures are also impacting on general treatment claims. So people aren't going to visit their physios, dentists, etc. So that's also dropping. So amongst all of this uncertainty, I guess we can think about this in both the short term and the long term. If I think about claim costs, first of all, short-term impact, certainly from the postponement of elective surgeries. In the long term, potentially also some impact from the elective surgeries being postponed, depending on how long this pandemic runs for. But also in the long term, our well-being, both physical and mental, and as one of the earlier speakers also mentioned, exacerbation of underlying health conditions going untreated for long periods of time will also have an impact there. If we think about the economic impact, which other speakers have also mentioned, there's a challenge of rising unemployment levels, which will no doubt put pressure on retention rates for health insurance. Also impacting retention probably in the more longer term is really the value proposition of private health insurance and what emerges at the end of this crisis. And that very much depends on the perceived performance of the public system as well as the private system. We talk about customer needs. Private health insurers are putting together hardship packages. Have they been adequate? Did private health insurers provide support to their members whilst they were waiting for their elective surgeries to be rescheduled? So I think a lot of these experiences, which kind of start getting back to the kind of conduct space, will affect the value proposition of private health insurance. So in terms of these uncertainties and how they impact on the work of health insurance actuaries, obviously interpreting claims experience and setting reserves when there is no historical precedence to draw upon. How do you develop reasonable business plans given all of this uncertainty? How do you come up with scenario development that hinges very heavily on government health policy? And then obviously subsequently the capital and risk management implications for that a very topical question that health actuaries are grappling with at the moment is how to set aside reserves for hospital claims that may have been simply postponed. So turning to the actions that HPC will follow up, we're working closely with COVID-19 task force at the moment. So the specific things we'll focus on is seeking thought leadership from both a health insurance and a health system angle. And this could be articles, guidance notes, etc. on that, consideration checklists and so on. We're also reprioritizing our focus. So before COVID-19, we were on the verge of finalizing our APRA submission on applying LAGIC to private health insurance. So we'll need to take another look at that and what we're saying there. And we're also off the back of what our GI and life insurance peers have done, also setting up a health appointed actuary forum. So in conclusion, while it's a time of crisis and survival and recovery are paramount, we can be mindful of the type of health system, as Andrew said, that we create as we meet this challenge. So that's it from me and Andrew, and back to you, Jennifer.
Thanks very much to Andrew and Ignatius. And just a reminder, we are getting questions through. If you do have any comments or questions, do keep them coming. There'll be an interesting process when we get to that point of answering them across the different practice areas. So our final speaker before we get to the questions is Paul Nuttall, who's looking at scenario and stress testing for the working group, as well as the content of the Pandemic Resource Centre. Paul's most recent role was actually running stress testing for the Commonwealth Bank, so he's got a lot of experience in this area, and I'll hand over to you, Paul.
Thank you, Jennifer, and good morning. These are certainly very difficult times, as people have mentioned. We don't know what the mortality rate is of COVID-19. We know that the number of deaths that have been reported globally are probably understated. We also don't know what the infection rate is. And we know that the number of cases that have been reported has been understated because of testing. And we also know that that will be impacted, the number of infections, by the government's response as countries come out of lockdown. And as others have talked about before, we don't know what the economic impacts will be. And again, that will be impacted by how the government responds and global governments respond. So there's a lot of uncertainty. And although actuaries are good at managing uncertainty, this one's a real challenge. And how do we help our stakeholders manage through all this? Well, one part of it is we believe it's very important for us to continue to model scenarios and stress tests on a best estimate view, a central view, and also on a stressed view to inform some of the decisions that have to be made. And the COVID-19 working group has set up a cross-party group to come up with some really thought starters and guidance on this, and the Institute will be putting them onto the website later today. I'll just sort of go through some of those with you. You've probably thought of a lot of this before, and some of the other speakers have covered some of these points as well, but hopefully we've thought of a few that maybe you wouldn't have thought of. And it is targeted at actuaries providing guidance to financial services organisations. Before I start, really, I should say, first of all, I'm very conscious it's very easy to say you should do this or think about this, and it's much actually harder to do it in practice. I would recommend that you don't start from scratch when you're coming to scenario and stress testing considerations. You've been probably running scenarios and stress testing for many years. So use the existing governance, use existing models, use existing stress tests if you've got them that are useful. You may have a pandemic stress test that will help inform some of your actions here. And try and adopt a quick and flexible approach. I think because there's so much uncertainty, it's useful to do a lot of what-if type analysis, and that requires high-level modelling and prioritisation as well around what are the product sets that are most affected by this. And coming out of that, you might be able to start setting some boundaries on where the outcomes are likely to lie. And then over time, as we get a little bit more clarity about how this will unfold, you might be able to tighten those boundaries and get a clearer view of how things might end up. I mean, in doing that modelling, you might think about, well, we'd like to run scenario saying, well, what happens if we ended up with the Italian experience or the South Korean or the US experience? And as Daniel mentioned, you'd want to probably think about correlations and causality in some of those assumptions. And what are you looking at? Are you looking at liquidity, capital, or both? I think some organizations are looking at liquidity really for the first time closely. Super funds are talking about liquidity where I haven't heard that before. And therefore you're going to be looking at a much shorter time period than say for capital, which is more of a medium and longer term view. In terms of some of the operational risk and capital issues, I'll just go over a few of those. As others have probably mentioned before, think about the volumes of claims and the availability of key staff. Are the staff, what happens if the staff are sick? Can claims management processes work as planned? Do you have access to medical information that you would normally have? And what's the mental well-being of staff and what impact will that have? What are the external pressures? What's the impact from regulators, from competitors, from government? Policy wordings. Are there differences in your policy wordings to your competitors, to your reinsurers that might cause problems? These are all things to think through. Asset valuations. Are there unlisted assets that might be difficult to value? Are there assets that you hold on your balance sheet that need to be impairment tested? Goodwill, for example. What's the solvency of the counterparties that you're dealing with? These are all things that you want to think through. And on the risk and capital side, are outcomes that you're seeing consistent with your risk appetite? Is ICAP working as planned? And Daniel mentioned some of these. Are the triggers that within ICAP working? And what mitigating actions are they leading you to? And do you need to build up your capital buffers? And if so, how are you going to do that? And what additional levels of shock do you need to withstand from here? And dare I say it, this is obviously a massive event happening here, but other things can still happen as well. You can get the double whammy impacts that come through. And then thinking through the mitigants, what mitigants have you used in prior stress in your ICAP? And are they realistic? Will they work? The expense reductions, the repricing that I think Daniel mentioned. Are they realistic? Capital raisings, if you need to do a capital raising, has the market or your parent got sufficient capital? What level of discount would you need to apply and what dilution will that create? And what are your competitors doing in this space? So what impact do they have? So those are the sort of things that we've been thinking about and we put into the note, which has gone on to the Pandemic Centre. I found that there's a lot of data out there at the moment globally, but it's hard to distill it into useful information a lot of the time. As Jennifer mentioned, we are looking at the Pandemic Centre to make that a little bit more accessible. There's a lot of good stuff in there, but sometimes it can be embedded in blogs, and it'd be good to pull that out. There's a paper that Thoughts for Life Insurance Actuaries that Jennifer, Alex Stitt, Colin Yellowlees and Michael Dermody wrote, which I think is a really good starting point for life actuaries, and I think that's going to be updated with more recent data. The paper that Alex Stitt wrote about pandemics back in 2006 is still relevant. Have you read that? It might be worth rereading or reading it for the first time. So from a stress testing point of view, the next steps for us are, we're putting that note out, it should be on the website today. We're keen to get your feedback on other areas for further development in scenario and stress testing. And then we'll update the guidance as further material developments occur. Thank you. Back to you, Jennifer.
Thanks very much, Paul, and thanks very much to all of our speakers. And I'm sure I'll be calling on you again as we get the questions through. We have got quite a few questions, and I'm going to start with a couple of reputation comments, and I'm going to try and summarise in a couple of places. So, question from EH, which Winley has already answered on the site, but I think it's worth actually mentioning again. The potential impact of reputation is reputational. If we are excluding too many claims because of existing terms and conditions, is this an issue for the reputation of the industry as a whole? Winley, did you want to talk a little bit about that for business interruption insurance and more generally?
Yes, hello. What I wanted to say is that historically, business interruption and indeed a lot of other types of policies have not been priced to cover vast and uncertain events such as pandemics. I think that going forward, there needs to be a greater discussion, I think, around pandemics such as this, which cause global disruptions. Given that the world is increasingly interconnected, are these pandemics as rare as we had previously projected? You know, we used to say these are like 1 in 250, 1 in 500 years even, that caused such an economic shutdown like the Great Depression and so on. We have had some people have mooted that it could be as frequent as a 1 in 30 year type event, which is no longer then as rare as we think it is. So I think there needs to be some discussion, I think, amongst the industry, not just actuaries, but insurers, as to whether we should consider removing such exclusions and incorporating them into the premiums for business interruption. So, you know, undoubtedly the premiums will go up, but, you know, by how much and should we be doing that?
Thanks. And I guess a similar question for Daniel on the life side. So Craig Thorburn asks whether we have any issues with the direct to customer facing insurers or entities, life, general or super, paying claims that might be grey or might be excluded, and the upstream risk carriers might be the insurers for super or the reinsurers for life in general. Have we seen any of that so far, and is that something we should be concerned about? So Daniel, if you want to have a go at that one.
Yeah, we've not seen any of that at this stage. Obviously, reinsurance arrangements for individual companies may vary in terms of how whether their treaty reinsurance has any sort of exclusion for pandemic versus separate pandemic coverage, and they'll have different trigger points and different layers. But we've not seen any particular issues with that. So I think that's one part of the question. I think to the extent that either individual insurers or the industry move to, closer to ex gratia payments for claims that are in a grey area, then that is an area where there's potential for a difference between the frontline insurers and the reinsurers. So it's not a move that's there yet, but would need to be agreed in terms of making sure that there is consistency in approach.
Thanks, Daniel. And Jeff, a similar question for you from Hua about direct insurers and pandemic exclusions versus the super fund version of pandemic exclusions. I'll just find the question again. Where are we? What Hua asks is, can Jeff explain the pandemic exclusion for group insurance? Is it even realistic to consider this for a default cover? So I don't know what your view is on that.
It's a good question. It's not realistic on default cover. It's more realistic on underwritten cover, perhaps. Where you tell people in advance that they don't have the cover, that's generally all right, and people purchase on that forewarned basis. Similarly, I mean, you wouldn't expect that people would expect to get pandemic cover in the middle of a pandemic, just like you wouldn't expect to get bushfire cover in the middle of a bushfire. So just on a reasonableness test, that might be considered okay. There are some group policies around that have historically had pandemic clauses, but they generally didn't apply to existing cover. So I think in general the industry's done that reasonably well. Where how it treats, just moving on to the broader issue of value for money, where the group insurance industry trustees and insurers are under the microscope from the community. It'll be very important that we make sure that people who are paying a full premium based on salary or an assumed salary don't get hit if they claim by a strict interpretation of their salary at claim time. I think that's a really important reputational issue for the industry, and it's an area where I think insurance and super working groups looking at that. Other people might be looking at it as well, but that will be a very important area. Communicating to people before they're claiming on what the interpretations will be on those policies will be very important in this situation.
Thanks, Jeff. That's a really good insight there on how the the difficulty of the direct to customer relationship, and then the behind the scenes insurer or reinsurer have to work together. I'm going to go to another life insurance question, I'm afraid, Daniel. Piri has asked what work we've done so far in determining the potential increase in mental health IP and TPD claims in relation to COVID-19. I suspect the answer is not as much as you would like, but it's not zero either. And before I throw to you, Daniel, one of the things that we are trying to do with the setup of the discussion groups that we're going to try and do this week or early next week is to enable individual practitioners to share information on this type of topic. So rather than somebody having to come up with the answer, we have a co-created answer to what kind of things we should think about in coming up with an appropriate set of assumptions. So Daniel, I don't know if you wanted to add to that in terms of the work that's been done so far.
Not a lot to add to that, and I was just typing a response to that question, so you saved me a bit of typing, which is much appreciated, given I've got a broken arm at the moment. So the work that's been done to date is really, there's a number of historic studies around impacts on IP claims, TPD claims, mental health claims through recessions. That's obviously been pulled back out and revisited, but there's a long way to go in terms of trying to apply overlays to that, to the particular circumstances we're seeing here. The impacts at different industries. If you look at retail and hospitality, obviously hit very hard. What that means in terms of insurance penetration into those industries, what type of cover they've got, whether it's group cover, retail cover, long-term benefits, short-term benefits, or lump sum benefits. And then the impact of the government stimulus packages. So what are they going to do in terms of cushioning the economic blow, and what is the trajectory for the economy recovering and coming back online, and it's going to vary by industry. So I think at this point we've got a lot of the questions laid out, but we're not a long way through the answers. And it probably ties back to that, picking your point, Jennifer, around industry discussion and sharing ideas, and that other question around what we do to try and get a more rapid consolidation of data across the industry to get these lead indicators, so we can start to see these trends emerging and to inform our views of what may play out over the next 12 to 24 months, as particularly the IP claims and TPD claims develop.
And then, Mike, I might get you to just talk a little bit about the answer that you've already typed up on the impact of the government stimulus program on morbidity experience. So what we know about the JobKeeper payments to date, and whether there's anything that you can share there more widely.
Yeah, I think it probably not much more than what I just said there. Is we need to look at how they impact different industries, and how different industries are actually what the primary impact is, and what the JobKeeper and other stimulus measures may do to mitigate that impact, and overlay that with the insurance coverage in those industries. So it's really difficult to call. Obviously at a high level, it can only be a good outcome if it's mitigating the loss of income and loss of jobs. But to the extent, understanding what the baseline is, and understanding then the reduction in that baseline or improvement in that baseline through these stimulus packages, we really aren't at that point yet.
Great, thanks, Daniel. Winley, I know you've answered this online, but I thought it might be worth covering the answer to the business interruption wording insurance question, because I think there's a more general question about wording. Not every policy is the same, and how we deal with the fact that some wording is not what we've discovered community expectations might be. So if you can talk through that, that would be great.
Unmute myself. That business interruption escapes from pandemic losses because of the exclusions in all the policies. I think for most business interruption policies, they generally require physical damage for a claim to be made, and they usually have a pandemic exclusion. However, I think it might not be I don't think there's a blanket, they're all excluded in that. I think it's important individually to check the policy wording for the individual policies. And also, later down the track, there could be some legal challenge as to the legality around these exclusions. We know that there has been political pressure overseas, particularly in the US, on the operation of these exclusions. So we'll see whether that plays out in Australia as well.
Thanks, Winley. Kirsten asked about the comorbidity data by age in New York, and I might quickly answer that because I happened to come across it yesterday. And I will make sure that we get it onto the Resource Centre of the Pandemic Exclusion, but there is information that's being shared daily in New York about all deaths that are recorded as COVID deaths, including by age, by location, and by comorbidity. It's not a death rate, so it doesn't give you the comparison of the number of cases, but it does give you the total deaths and which deaths have comorbidities by age, which I think will be useful as we're trying to understand what the genuine risks are, whether the corresponding high death rates in high ages and high comorbidities are just because people at older ages tend to have comorbidities, or whether there's more to it than that. I've also got a couple of questions about the volunteering. We are trying to make sure that we actually manage to use all of the volunteers we can, because there is a lot of work to do, but we also need to make sure that we ask you to do things that are worthwhile. So yes, very much we're keen to get people involved in particular areas. So if you've heard something in this conversation that you're interested in, please get in touch with the relevant presenter. But bear with us, because as I said at the beginning, we've had 80 volunteers so far, and we're trying to make sure that we use this great volunteer workforce we have the best we can, rather than just asking you to do things that won't be worthwhile. So it's getting that right balance between getting everyone involved and getting everyone involved in ways that will really add value. I noticed also we have a couple of questions about DB. An anonymous attendee's asked for DB funding, whether we need to consider employee covenants more closely. Jeff, I know you're more on the life insurance side of super, but I don't know if you're able to answer that question.
Yeah, sure. I don't think it's any more an issue this time than last time. I think we've gone through extreme financial pressure on particularly vested benefits before, and employers providing covenants have been in place to my knowledge. I mean, I do work in the defined benefit area, but not as much as a lot of other actuaries. So, but my understanding would be that it is nevertheless an issue that's been addressed historically, and so we should be pretty well prepared for that sort of thing. I mean, it was a market crash, you might say, was coming. We didn't know why it would come, but a market crash was coming. So yeah, we just see that every time the vested benefits index in one of the funds I look at goes through 130, the market crashes, as for years, decades.
Thanks, Jeff. There's probably one more practice area specific question that has been answered online, but I might ask Daniel to just talk briefly about it, which is the participating business. So that's almost as specialised as defined benefits these days, but there's probably other people in the webinar who are interested in the answer to that one.
That question was just a bit more detail on the impact on participating portfolios. So obviously the immediate movements in asset values and potential changes to views around future investment returns and potential future investment strategy have implications for the supportability of bonus rates on those portfolios, and potentially the mix between reversionary bonuses and terminal bonuses. So it's very company specific and will depend on current investment strategy and how the portfolio has been impacted. But one of the things that actuaries with those types of portfolios will be looking at is sustainability and equity of current bonus structures, given the events that we're currently seeing, and whether they need any changes, which they're more likely to be smoothed out over time. And the flow and impact of that is to the extent that bonus rates move, and so to shareholder profit distributions.
Thanks, Daniel. That's useful for that small group who still has to deal with power issues. I've got, I think, only one more very specific question, but which I'll ask Winley to answer. But before I do that, I might ask Andrew and Ignatius to think about whether there are any questions so far that are relevant for health, and I'll throw to you after that. So the question for Winley is, in light of the focus coming from both the bushfires and now with travel insurance and business interruption, do we expect a greater push for standardised industry definitions coming out of this? And Daniel, you might have a comment on that after Winley as well.
I think undoubtedly, I think the answer is yes, but I think the push so much is not so much from the on the legal side, but more from the public, I think. I mean, I think it's just sensible for the industry anyway to have clarity around what we are actually covering. So, you know, what is a flood? What is a fire? We can sort of have standardized industry definitions, but I think the important thing is to be clear to the public when they make a claim, what exactly we're covering. So I think we need it in a sort of plain English, you know, rather than being tied up in all the legalese around, you know, is it a storm surge, is that a flood, and so on. I think we just need to be clear about that in a plain English, public-centric perspective. My answer.
I think that's the words we should all be careful about in all of our practice areas. Thanks, Winley. Daniel, any comments from a life perspective? Particularly, I guess trauma would be one that we talk about a lot.
Yeah, I'm probably not a lot to add. Obviously, in trauma, then I don't think it's impacting a lot of the trauma definitions here, and sort of standardisation of definitions there is probably a separate debate to the current COVID impacts. I think obviously where there probably will be consideration is, you know, the life insurance industry is currently reviewing its disability income products, and you know, that work was ongoing anyway, and the impacts of the COVID-19 pandemic may definitely feed into consideration around appropriateness of definitions and what may change in future. And probably an immediate one to look at, because it may be treated differently between products and indeed between different policyholders within products, depending on occupation classes, is how the government payments would actually offset with existing benefits. And I suspect there may be, if not uncertainty, different treatments there across products and policyholders.
Yeah, that's an interesting point, and one that's not necessarily in anybody's policy definitions as yet.
Yeah.
Andrew, I might throw to you. Are there any, we've had quite a lot of GI and life and super focused questions. Are there any questions that are more amenable to health as well that you wanted to make a comment on?
Yeah, there's quite a few. I'll pick on one, which you probably will also pick up some other aspects of, and that's Naomi's question on the intergenerational impacts. And, you know, we've heard and seen newspaper articles about the boomer remover and all sorts of things. But it's very real. Behind all this, we talk about statistics, but there are people, there are human beings, and there's a human element. And those aspects are very different for young people and old people, and we talk comorbidities, but behind all of those are people. So I think we should pick up that in the next phase, Jennifer, of our committee. It's not just a health issue, it's more an intergenerational issue, but both the pandemic and the severe economic disruption are going to hit different cohorts of our communities differently. I don't know, Ignatius, did you want to comment on any?
Yeah, maybe just pick up on the question about reputation, and this is something that I think is a big risk for private health insurers in particular, given this time at the moment where they're continuing to collect premiums, but obviously the inability to go to private hospitals for elective surgeries and not making use of general treatment. What is the service that health insurers are providing in response to, whilst still continuing to collect premiums? I think that's a very difficult question to answer, and how consumers are being treated, that whether there's consistency around that. We talked about, someone else mentioned ex gratia payments. Will we see more of that in health insurance? I think there's a lot of issues there that health insurers will have to be grappling with.
I think, Jennifer, too, if I could pick up on one other issue, it'd be the questions that have related to mental health. I know health actuaries and health insurance have been grappling with this because we had new clauses around mental health and waivers of waiting periods to upgrade your cover before this crisis came in. I think it's too early to know what the impact on mental health is, but the risk is, Ignatius used a nice phrase that people might have picked up on early, but instead of the social distancing that we're continually hearing talked about, Ignatius used the word physical distancing. And I think that's that's really the essence of it. One of the things to avoid mental health is social connection needs to be stronger than ever before. So adopt physical distancing, but social distancing, reach out, connect. And if we connect more, hopefully, in this environment, mental health claims might even be less.
Just to add one more thing on the mental health, I don't know if this is an opportunity to share more data across industries. So health insurers would have their data, life insurers likewise, super. Maybe that's a question we need to think about.
Yeah, thanks. I agree. And one of the things that I've discovered just from this working group over the last couple of weeks is there are a lot of cross-practice area issues, and we're so used to answering questions in our own practice area. It's important that we all think carefully about the rest of the profession. I think you can see from this presentation alone, there's a lot of very interesting cross-practice areas issues, and that's one of the functions that we see of our working group. I might come to some of the kind of more longer term questions. Naomi, as Andrew mentioned, talked about intergenerational equity and whether we should be thinking about intergenerational equity in our working group. We've started talking about retirement incomes, which is obviously one extreme end of intergenerational equity, but I think we also need to think about a broader question, and that comes back to the value that actuaries can add in the wider community, in terms of using our ability to think about the future long term in a financial way. So Julia Lessing's aspect of the working group is looking at how we can help thinking about projections of the whole population. I think we'll ask her to think about that and whether we can actually pick that up with all the many volunteers we've got from the profession. So Craig Thorburn also asked about whether we should be looking at whether we need risk pools for things that are excluded, and that is something that has actually come up in the working group, but something that we thought it was too early to think about. So along the lines of the reinsurance for terrorism, which we have in Australia, and the reinsurance for earthquakes that New Zealand has, whether there are other things along these lines that we should be thinking about in terms of risk pools. I don't know if anybody on my panel wants to add to that. I guess Winley's probably the closest to it, but anybody got any comments on that one?
Jennifer, it's Andrew. The only comment I'd make on that is it's not just an Australia issue, it's a global issue. And it's interesting that we have pools for natural perils like cyclone, which we think are it will happen. It's just not sure when and how much. And yet you could argue that around the world we will have pandemics, and there's nothing really around global health security. And I expect that will be something that gets a focus coming out of this.
Yeah, that makes a lot of sense. Thanks, Andrew. Cynthia asks what roles regulators can play in protecting insurance policyholders and superannuation fund members, including preserving the viability of the industry. And that's actually quite a tricky one in the context of some of those exclusions we talked about. There's a lot of community expectations that some exclusions will be relaxed at the same time as APRA's role in particular in a regulatory perspective is to make sure that the financial viability of all of our regulated entities is okay. And those two things can be in conflict. They're not necessarily in conflict. So that's an interesting question, and one in which I think we as a profession can play a valuable role in just making sure that everyone understands the financial impacts of the kinds of things that people are being asked to do all of the community should be pulling their weight in making sure that we're covering things as we can. But if the financial impact of something we're being asked to do is too great, it's important that the decision makers understand what that is. I don't think we've got a poll for this one. Kirsten notes that alcohol sales have gone up, so hopefully that's not going to affect either our mental health claims or our physical health claims. So anybody who wants to answer that on the website, I'd be interested to see whether people are drinking too much. And I guess we've got a question from Annette about super funds, which is probably back to a very specific question. How are super funds ensuring and reserving for continuation of cover when members fall out of the system over the last month, particularly with PYS and PMIF? Jeff, I don't know whether you've got a quick answer to that because it's a complicated question, but do you want to give it a go?
Sure, thanks, Jennifer. I can't find the question, but In terms of, it's not the super fund's responsibility to pay claims that shouldn't be paid. So they have to act in accordance with their trust deed. They can only pay claims that are legitimate and can be paid under the deed. So I don't think they're going to be just willy-nilly making up the shortfall, particularly on PMIF and PYS. I mean, that's legislated. The government knew what it was doing. People warned it about it. So it will be a government cost in the end, the additional claims that come through on the social security system, presumably.
Yeah, thanks, Jess. I think that makes a lot of sense. Now we've reached, I think, close to the end. So what I'm going to do is just summarise a little bit of what we've done and thank everyone. So first of all, I just wanted to talk a little bit about what we've done today is very much focused on our membership and their professional obligations. So what do we need to do as members of the profession to support the companies that we support? So our health insurers, our life insurers, our general insurers, our super funds. And the stress and scenario testing was very much on that basis. The other leg to what our working group is trying to do is trying to make sure that we are using our skills as best we can to support the wider community. And to that end, Douglas Isles, who's on our working group, has released something today, which is been picked up by the Fin Review on understanding the general modelling that people are doing. And what we're trying to do there is provide insight from our understanding of modelling, not build our own models, but provide insight to the wider community of what the modelling might mean in a practical sense. And while we always beat ourselves up as actuaries about our communication skills, professionally we are trained to try and communicate risk to people who don't know as much about it as we do. So I think we can add a lot there. And so what we are trying to do as a working group is that as well. And I think if we have another one of these Horizon sessions, we might focus more on that community aspect. But what we will be doing is having a number of these kinds of sessions going forward for individual practice areas. And as I said before, we'll be putting more information on the website, but also setting up discussion groups so that people can share information, share the work that they've done, so that we can support our companies that we're supporting and support the wider community as best we can. So in closing, I'd just like to thank all of our speakers, Win Lee, Daniel, Jeff, Andrew, Ignatius and Paul. Thank the Institute staff behind the scenes, particularly Sarah, Zoe and John, who've enabled us to have this virtual webinar. It's a bit scary that our very first virtual webinar in this situation had more than 400 people watching. So thank you to everyone who's watched and thank you to all of your questions. And I hope this is the first of many successful webinars to come before we get back to finishing our physical distancing, but we're keeping our social connection up with the webinar. So thanks to everyone for your participation and thanks to all our speakers.